Well, we printed money in 2008. We printed money in 2001. Why is it causing inflation now? What caused the Roman Empire to collapse? And you can point out a lot of different things, but if you look at the economy side, it was the debasing of their currency.
Is the entire world on the edge of an economic crisis right now, or is it only the United States?
The United States is facing a two-part crisis. We're facing an inflationary crisis and an economic slowdown, which could turn into an economic crisis depending on how the fight on inflation goes. And the entire world is facing their own issues of inflation and an economic slowdown. And because the United States is the largest economy in the world, that plays a factor into every other major country in the world. I mean, you can first look at countries like Sri Lanka. Sri Lanka declared default on their national debts earlier in 2022, which means that the government spent so much money that they could no longer afford their debt payments, that they declared default on their national debt, that essentially that meant that their currency and the economy went into just crisis mode and the entire economy collapsed. Then you have Germany right now that's on the brink of crisis/collapse because they were moving so far into this green energy and they were reliant so much on Russia and Russia's gas. And now that Russia has turned it off for Germany, it's really hurting them. So you have a lot of different countries around the world that are struggling economically, but then you also have the inflationary side. And this is the first thing that I think everybody has to understand about what's going on right now is inflation and recession are two sides of the same coin, but they're two different things. Like the inflationary issue that we're seeing is leading to an economic slowdown. Between 2020 and 2021, we had an insane amount of money printing without any sort of wealth creation. So what does that mean? That the government and the Fed were spending money and printing money at the fastest rate that we've ever seen, while no wealth was being created. So if you print money, you produce money without producing any value, without producing any wealth, the value of each individual dollar goes down. This is inflation. This causes then the price of things to go up. Now, in addition with this inflationary issue, you also have supply chain disruptions. We had manufacturing plants in China shut down. We had issues, labor shortages in America. We had just a whole bunch of different supply chain issues which disrupted then the production of items, which also contributed to the price of things going up. And now when you have the price of things so high, people don't have the ability to spend on other things, because now when you have to spend almost all, if not all of your income on your rent and your groceries, now you have less money to go out and spend on vacations. You have less money to go to the Gucci store. You have less money to go to the Louis Vuitton store, because now all of your money is going to your rent, your groceries, and your gas. And so when you have less money to spend on other things, discretionary things, this causes an economic slowdown. Now, the reason why this is so important to understand is because most of us have never experienced something like this in our lifetime. When the 2008 crash happened, we were not worried about inflation. That was the last concern in everyone's mind before the crash, because we had inflation at around 2%. So when the crash happened, the economic crash happened, meaning spending slowed down, businesses slowed down, the economy slowed down, the Federal Reserve Bank could come in and create inflation to stimulate the economy. Because then the Fed worked with the government to send out stimulus checks, they cut interest rates, and they did quantitative easing. All that means is the Fed and the government printed a ton of money after the 2008 crash, injected it into the economy, and that got the economy booming again. So you had an economic slowdown that was turned into a boom thanks to inflation. 2001, the exact same thing happened. We had an economic slowdown because we had this big boom in the dot-com tech industry, and that started to collapse in 2000. And that was when we started to see markets go down. People started to lose their jobs. The economy was slowing down. That's when the Fed and the government started creating inflation. They did a lot of stimulus. We did quantitative easing. We printed a whole bunch of money, and we boosted the economy. Well, now we don't have that luxury, because we are going into an economic slowdown. We're already in an economic slowdown, but it's being induced by inflation, meaning all the money printing that we did in 2001, all the money printing that we did in 2008, all the money printing that we did in 2020, 2001, all 2021, all these things are being piled up together now because now we're facing the price and the cost of inflation. And because of that, we're now going into a recession induced by inflation. So we don't have the same luxury as before where the Fed could just open up the money printer, cut interest rates, do quantitative easing, send out stimulus checks, and expect things to get better. Because if, let's just say, I mean, I know California has talked about this, but let's just say the government now sends out a $2,000 stimulus check to everybody because they say, your groceries are expensive, your rent is expensive, cost of living is expensive. The government wants to help you out in this high inflationary time to get the economy booming. And they sent out a $2,000 check to everybody. They called it a stimulus check. Well, what that would be is an actual inflation check because that would create more inflation. The government doesn't have $2,000 to just send to everybody. But if they did, that means the Fed would have to print this money out of thin air. They send it out to people. Now you go and spend it. Well, what's going to happen? Amazon's going to boom. Gucci's going to boom again. You're going to see big lines at a lot of stores because they're not going to be able to produce the products quickly. And in the short term, you're going to see a big boom in the economy. But then the inflation starts to kick in. That's when people start to realize that, oh my God, my $2,000 doesn't buy me as much as it did a year ago, 2 years ago, 5 years ago. And so that's why, you know, the stimulus checks are actually inflation checks. And it's not just to people. It's the same thing when you give money to businesses. It's the same thing when you give money to anyone. When you spend money you don't have, somebody has to pay the price. And so when the government spends money, either they can pay for it through higher taxes. So they can raise their taxes, but then that makes people upset because now more of your income is going to taxes. Or they can cut your benefits. So they can cut your Social Security, they can cut your welfare, but again, that's going to make people angry because now you're getting less stuff. Or they can do it through inflation, which is a hidden tax without any legislation. So now they print money, they spend money, and then you pay the price still, not through a federal tax or through a state tax or through an income tax, but through the inflation tax. And the person who pays the inflation tax the most is the person who doesn't understand inflation, is the person who doesn't understand money, is the person who's not financially uneducated, and is the person who's typically poor. And this sucks because we're never taught about this. We're never given this sort of financial education. We're never given this sort of money education. We're never taught about inflation. My first video to go viral, kind of funny, is a video that I made in 2016, in March of 2016. And the video was titled, "You're Guaranteed to Go Broke If You Do This." And the premise was inflation at that time was hovering between 2 to 3% a year. And I said, if you keep your money in the bank, which is paying you sub 1% a year, was significantly less than 1%, but let's just say 1%. If you keep your money in the bank that's paying you 1% a year, while inflation is 2 to 3% a year, you're losing 1 to 2% of your savings value each and every year. And that video began to go viral because people started to realize what inflation was and how it makes the average person poorer when inflation was at 2 to 3%. Right. Now inflation is 8 to 9%.
Yeah.
Not slowing down, still going higher. And then interest rates on banks are still paying next to nothing. And now we're starting to see the impacts of inflation. This is where everybody says, well, we printed money in 2008. We printed money in 2001. Why is it causing inflation now? And the best example that I can give you of this, I mean, it's just think of it like a drug. You can do heroin. It's not going to kill you. And after you do it, maybe you need more dose. You need more to get that same high. And you chase more and you need more. That doesn't mean that it's good for you.
Right.
That doesn't mean that it's not causing any harm. But eventually, if you keep increasing the dose of something that is bad, it will cause harm. And this is what we've seen happen across civilizations, across time. And Ray Dalio talks about this a lot. A few economists talk about this a lot, in the sense of when a country or economy or empire becomes the leading empire of the world, like the United States is right now, you kind of act like the big brother of the world, where you need to take care of everything. You need to take care of your people. You got to take care of other countries. You got to take care of anything that's going wrong in the world. And so it's almost like this pressure where you are in charge of taking care of everything. And there's a price to that, right? I mean, either you have to tax your own citizens and pay the price to take care of the world, or you're going to have to cut their benefits, or you're going to have to pay that tax through inflation. And when you spend too much, eventually it's going to catch up. And somebody always has to pay the price for that. And inflation, someone always has to pay the price for printing money, right? There's no free lunch. And the most expensive kind of money is free money. And that's where, it just builds up. You just go back to look at the Roman Empire. What caused the Roman Empire to collapse? And you can point out a lot of different things, but if you look at the economy side, it was the debasing of their currency. The Roman Empire used to transact on silver coins, actual metal. And the government wanted to expand. They wanted to grow their military. They wanted to build their infrastructure faster. So they started debasing their currency. They started mixing other cheaper metals with their silver and paying people in this cheaper metal. And then eventually people started to realize, I need more of this cheaper coin to now go out and buy things. So people demanded more money. And this ultimately created a currency crisis. And that was one of the factors that led to the collapse of the Roman Empire. So inflation is the issue that we're facing right now, and it is leading to an economic slowdown. And this is where now the Federal Reserve Bank has to pick its poison. Do you want to fight the inflation, or do you want to fight the slowing economy? Because in order to fight the inflation, it is going to cause a recession. I know still to this day today, although the Atlanta Fed predicts that we're in a recession right now, you still have a lot of people saying that a recession is not inevitable, that we're not for sure going into recession. Now, this is just my opinion, but I really don't see how we can sidestep a recession.
Right.
I think if we're going to fight inflation, we're going to have to induce a recession. We're going to have to induce a market crash. It's painful. However, it's not as bad as the alternative, which is you now start fighting the economic slowdown, meaning you create more inflation because now you're worried about job losses, you're worrying about companies going under. So what do? You start inflating, you start printing more money, you start doing more interest rate cutting. This is already, I've read like a number of articles now of traders in the stock market who are betting that the Fed is going to start cutting interest rates soon.
Really?
In 2022, yes, because they're saying that now we're seeing the layoffs. Just look across the tech sector. I just saw on CNBC, Voyager, I think's their name, they had cut all withdrawals, but then they just declared bankruptcy. We saw a number of different companies announce layoffs this week in June and May and July. We've been seeing layoffs pretty much every day across companies. And so you have some traders saying the Fed is not going to just stick with this fight on inflation because they're seeing how it's affecting the economy. And so they're going to start cutting interest rates to help boom the economy again. If you do that, you're 100% right. You're going to create an economic boom in the short term. But you're going to create a significantly bigger inflation problem. And that problem is not going to get cured by itself. And that cure is painful. However, if you don't cure the inflation problem and you just focus on the economy and let the inflation problem get worse, well, it's going to be even more painful to deal with the inflation problem. Because if we deal with something like a currency crisis, now we're in trouble. Sri Lanka just had to deal with this. And the entire economy essentially collapsed in Sri Lanka. Because when you face anything like a currency crisis, well, when you're the United States and you're the world's reserve currency, you are the world's reserve economy. You are the world's superpower. The whole world is saving their money in dollars. That's the safe haven for the world. So the world relies on the Federal Reserve Bank to be stable, to take care of inflation, to protect their money. Because now if you're a country, let's just say you are Japan, and you save your currency, you want to save money and you put your money in dollars, well, you don't want to see high inflation. Because now when you save a huge sum of money in dollars, that means that your money that you're saving in dollars is losing value every single day. And so if these countries then start to lose trust in the dollar, they start to lose trust in the Federal Reserve Bank, they start to lose trust in the United States economy because we've been facing a high period of inflation, well, the worst thing that could happen is they ditch the dollar or they dump the dollar. And that would cause the value of the dollar to go down. And this is the currency that we've been transacting with, that we're living off of. And, most of us have never even had to think about what would happen if the dollar began to lose value, because even growing up, you and I, we never faced any sort of high inflationary times or issues.
Not like this.
And this is something that the last time we saw something remotely close to this was the 1970s. And so most of us have never experienced anything like that. And if you don't get the inflation problem under control, then you risk the health of the dollar, and that could be a much worse problem.
Yeah, absolutely. And when it comes to that economic slowdown, what factors could ultimately lead us into a much bigger recession?
The recession is really how aggressive the Fed gets now to fight inflation. So you got to look at, what is the Federal Reserve Bank going to do? Because the Fed fights inflation by raising interest rates. When you raise interest rates, borrowing money becomes more expensive, which means that on one hand, doing business becomes more expensive. If you want to buy a home, it's more expensive. Your mortgage rate's higher. If you are a corporation and you want to borrow money to grow your business, you need a bigger return on your money, because you can't borrow money for 2.5% anymore. You're going to pay 6.5% if you're a business, at least. So it becomes more expensive to grow. And if you're a business that needs money in order to grow faster, because you're a startup, you rely on outside capital, well, now it's much more difficult for you to find money, because investors want a higher return on their investment. So if you're a startup, like the tech companies that have been doing layoffs, well, in 2021 and 2020, it was easy to find money. Companies, institutions were throwing millions, if not billions of dollars at some of these corporations, because they thought that you had a good idea. And so they were willing to give you an insane amount of money, and businesses were able to grow very quickly. Well, now those same businesses are struggling because they need to turn a profit, because now investors are saying, we don't want to throw our money into speculative companies. We don't want to throw our money into companies that are not a sure bet. So you need to show us that your company is a good investment. So now companies are saying, well, we have to produce a profit, which means we need to cut our costs. We need to raise our revenue. Well, when you're in an economic slowdown like we're in right now, raising your revenue becomes very difficult. So companies are trying to raise revenue, but they're fighting an economic slowdown. And then the second side is cutting costs. What's the easiest way to start cutting costs? Layoffs. Fire people. Let departments go. And that's what we've been seeing happen. And the scary thing is we really haven't raised interest rates that high. Historically, mortgage rates are still very low. Historically, interest rates are still extremely low. And so, we're talking about, the Federal Reserve Bank is talking about bringing interest rates up to 2%, around there, while inflation is at 8 point some percent. It's crazy because, interest rates are not that high right now, but you're seeing the effects of this just slight raising of interest rates. And if we stay more aggressive, because if the Federal Reserve Bank, I keep going back to them, this is going to be the indicator as to which direction the economy is going to go. So if there's anything that you get out of this video, just understand this. The Federal Reserve Bank is going to tell you which way the economy is going to go. If they keep raising interest rates, you can bet the economy is going to go down. If they start cutting interest rates, you can bet the economy is going to go up. This is in the short term, because if they start cutting interest rates, meaning they start creating more inflation, the economy is going to go up, because now more dollars are going to enter our economic circulation. And that's just kicking the can down the road, because that's going to cause higher inflation. The person who's going to pay the price then is going to be the average person. Again, asset prices will go up and the cost of living will go up. Wages will not keep up with the higher cost of living. You're going to see a wider divide between the haves, the have-nots. You're going to see a wider divide between the rich and the poor. The middle class gets wiped out. If the Fed says, we're going to stay true on our fight for inflation, we're going to stay true to bring inflation down to 2%, which is what they say they want to do, well, then they're going to have to keep raising interest rates. If they keep raising interest rates, it's going to continue to hurt the economy. The more they raise interest rates, the more it's going to hurt. An easy way to understand this is just to think of a bubble. We talk about bubble economies. The bigger the bubble, the bigger the crash. Well, in 2018, 2019, this was when our economy actually started to slow down. So this is when President Donald Trump was in office. And the claim was we're in the strongest economy of all time. However, if you look at the actual data, our economy started to slow down. And companies, especially the tech startup companies, started to slow down. And they started to do layoffs. Companies were worried about valuations. They were worried about how they were going to raise money because it was becoming more difficult to do so because investors wanted higher returns and they wanted to see real sustainable growth. And so in 2019, President Donald Trump put a lot of pressure on Jerome Powell, who was the chairman of the Federal Reserve Bank then and now, to start cutting interest rates. So in 2019, we started cutting interest rates. We started inflating the economy in 2019, even though we were supposedly in the strongest economy of all time, although we were slowing down. So 2019, we started blowing the bubble back up with this air. And then 2020 came, the pandemic came, and we just put this air blower, the money printer, on high speed, full blast, put in like extra air blowers, and we just inflated this bubble to max capacity in 2020 and 2021. And now we're realizing the effects of blowing up the bubble that big, which is inflation. And now we're trying to fight the inflation, which is going to hurt the bubble. So there's a lot of different things that we have to, that can affect the economy. But the one source that you want to pay attention to, especially, is the Federal Reserve Bank, because they are going to dictate which direction the economy is going to go. And this goes to all asset prices as well. Stock prices, real estate prices, crypto prices. If we keep raising interest rates, you can expect asset prices to come down. And of course, there are exceptions to this. If you are in a strong economy, robust economy, you're in an economy that's self-sustaining, and you start raising interest rates, that doesn't necessarily mean the economy is going to go down. You can see the stock market go up in a time of rising interest rates, but that requires the economy to continue growing because the economy is growing faster than the rise in interest rates. However, we don't have that strong, robust economy right now. Companies are still struggling finding labor. I mean, like here in Michigan, it's still so hard to find any restaurant open after 10 p.m. Right. It's nearly impossible. Fast food restaurants can't find labor. Restaurants can't find labor. Retail stores still can't find labor. And people are struggling paying for their everyday lives. Rent prices are going up. Grocery prices are still rising. So it's a very strange time. And there's a lot of things that have to be ironed out. But again, where do you look to see where we're going? Obviously, look at the Federal Reserve Bank, but also you can also look at Market Briefs, which is the free financial newsletter that we have that I created, which keeps you up to date. I'm going to put a little shameless plug here. If you have not joined Market Briefs yet, it's a completely free newsletter where our team breaks down what's happening in the top finance and business news into a fun, witty, easy to read, entertaining email. You can read it in less than 5 minutes every morning. If you haven't joined Market Briefs yet, I'll put the link for you down in the description below.
If this bubble keeps kind of expanding and this recession gets worse, what can 90% of people in the United States expect?
Well, you can expect more layoffs. You can expect more companies to get hurt, and you can expect this to hurt Wall Street. And this is where the question is, what do you do? Because we are brewing something that is going to be painful. Either we're going to pay it and go through it now, or we're going to do it next time. And the question is now, what do you do? Because the factors that we have leading up to this crisis, economic crisis, are worse than what led up to the 2008 crash. Because the 2008 crash was an economic real estate crisis. There was a lot of bad handling of financial assets. There was a lot of bad handling by Wall Street. And what happened in the housing market then trickled down onto Wall Street, almost triggered a whole financial meltdown. Well, now we have a whole economic issue. We have the whole inflationary issue across the markets. And this has trickled down into every single asset class, which is why a lot of people call it the everything bubble. It's not just real estate. It's not just stocks. It's not just, just everything. Look at crypto. And then on top of that, it's not just the United States. It's the world economy. Every single country, developed country, printed a lot of money during the pandemic, during the 2020 economic shutdown to help fund the time during the pandemic. Well, everyone's going to have to pay the price for that eventually. And so these are the things where there's a lot of things you need to be aware of, which is what we discussed. But now the question is, what do you do? Mm-hmm. And I say this a lot, and you have to find the opportunity, because more millionaires are made during economic crashes and recessions than any other time. For investors, the minority mindset thinkers, recessions and economic crashes, market crashes are a good thing, because this means you can go out and buy assets that pay you on discount. And this is the time where the majority of people are freaking out. The majority of people are running away. The majority of people are saying you need to sell, get away from everything. The market's going to go down to zero. Markets are collapsing. The entire economy is going to collapse. Everything's going down. The whole world is going to end. Now, if you believe in the long-term health of the economy, if you believe in the long-term health of the American economy, if you believe in the stock market, if you believe in American companies, if you believe in America, I do, then this creates opportunity to purchase investments on sale. It's almost like Black Friday for investors, but it requires that first, that psychological discipline, and then the financial education, because when asset prices are crashing, it's very scary, especially if you're invested. You see your investment portfolio go from $1,000 down to $900, down to $800, down to $500. Now you're going to start freaking out. What is going on here? Is this going down to zero? If it's going down to zero, you want to get your $500 out as fast as possible. But you have to be able to understand which direction it's going. And this goes down to then the financial education of being able to find good assets. And so this is where you want to look at, okay, I want to invest in stocks, or I want to invest in crypto, or I want to invest in real estate, or I want to invest in businesses. You figured out what it is that you want to invest in, and then you start finding the good assets. If you want to invest in stocks, look for the companies right now. Which companies do you want to be invested in? Which companies are producing still strong profits? Which companies are profitable? Which companies pay out a nice dividend? Which companies are going to be around for a long time? Which companies are innovating? Which companies have strong cash flow statements? They've been good with their cash. And you can find all this information out online. You're going to have to do some digging, but this is the type of information you want to be doing. Once you do this information, you make a list of the investments that you want to make. The next thing you do is just look for a good opportunity to buy. And this is where a lower price provides a good opportunity to buy. However, the sentiment during the time when prices are low are sell, 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 never buy, run away. But this is where if you have a good investment, that's when you want to come in and buy. I'm telling you this from experience, because when I first started investing in stocks, it was at the bottom of the 2008 crash. It was like 2008, 2009, around that time. We're in Michigan. GM was on the verge, or GM went bankrupt, Chrysler went bankrupt, Ford was on the verge of bankruptcy. And when I first bought, I don't think GM and Chrysler had declared bankruptcy yet. It was right around the time that they did. But I didn't have much money. I wanted a Ford Mustang. My dad said I can't have one. So instead of buying a Ford Mustang, I went out and bought a Ford stock, which was $2 at the time. And I didn't have a lot of cash. I don't know how many shares I bought, but it wasn't much, maybe $100 worth of shares or something, but Ford at $2 a share. And over the years, that Ford stock multiplied many, many, many times over. And you don't need a lot of money to invest. I wasn't making a smart decision. The only investment analysis that I did was I wanted a Mustang, and I liked Mustangs, and Ford made Mustangs, so it was the closest thing that I could do to get a Ford Mustang, but it was a $2 stock. If it was GM or Chrysler, I would have lost it all because they went bankrupt. But it was just, I got lucky with that. But that was when everybody was saying you need to not buy, run away, don't buy stocks. The entire market's gonna go to zero, and it did for some companies. But if I was smarter, maybe I would have done some actual research. Same when I started buying real estate at the bottom of the real estate crash. Everybody was saying how you would have to be out of your mind to buy real estate when it was at rock bottom. How real estate is a horrible investment because it's caused so many foreclosures, so much hardship. It's caused so many defaults. It's caused so many bankruptcies. You want to stay as far away from owning real estate as possible. I said, I want to be a real estate investor. Every business book talks about how wealthy people own real estate. So I understood from the long-term perspective that, hey, real estate can provide cash flow. You own a tangible asset, and I wanted to do that. Same thing with stocks. I like that with stocks, you're investing in a company, and you're investing in the assets of a company, the cash flow, the infrastructure, the machinery of a company. And so for me, I understood that, kind of. I didn't really understand it fully at the time, but I understood that I wanted to own this thing. So I started buying it, and it turned out that I was right. and over time it grew. And anytime you see markets go up, people get greedy and they say you have to come in and buy now because everybody's making so much money. However, when the market's at their top, that's not the best time to buy. That's the worst time to buy. When everybody's saying you should buy because everyone's making so much money, that's the worst time to come in and buy. But then that's when everybody's buying. When markets are at the bottom, that's when everybody says it's the worst time to buy. You should not buy. Everything's going down to zero. Don't buy right now, but that's the best time to buy. So this is where you have to be able to decipher all that noise, do the research, and find the right investment. Now, this is, again, if you're an active investor, you want to find the right companies, you want to invest individually, actively, that's what you do. Another thing you can do is to set up a passive system. I have this as well. For me, it's every Wednesday, I have cash leaving my bank account that goes and gets invested into a few different ETFs, which are funds that give me exposure into a number of different companies. Some of them give me exposure into the S&P 500. Some of them give me exposure to tech. Some give me exposure to emerging markets, which is companies outside of the United States. So it's a completely passive thing, happens automatically, happens every week, whether the market's up or down. It does not matter because I believe in the long-term value of that. And this is where you have to understand that the people who make the most money are the people who have the long-term mindset. It's the people who are not investing for 2 months or 6 months or a year. It's the people that are investing for the long term. And while traders can make a lot of money in short terms, short periods, when you have those booms, well, when things go down, traders are the ones that lose the most. So this is where you have to figure out your strategy and just be willing to buy the good assets when prices are low, but that also requires you to have some cash, which means when times are okay, put aside some cash. Create a margin, live below your means, try to earn more money, put some cash aside. That way you can buy the opportunities that come your way.
That's good advice. Why is this world economy right now so unpredictable?
Well, because we don't know which way the Federal Reserve Bank is going to go. And it's always unpredictable because we never know what's going to trigger the next domino. So the best way to predict what's coming next is just to look at what happened before. And a lot of times we try to trust entities. We trust the Federal Reserve Bank. We trust the government. Now, before I even talk about 2020, if you look back at 2001, these are probably the crashes that most of us remember. I have it back here behind me, the newspaper articles from it. But before the 2000 dot-com bust, the Federal Reserve Chairman Alan Greenspan at the time talked about how there's no dot-com bubble. How could there be? You would be crazy to think that there is a dot-com bubble, that the economy is robust. And then slowly the bubble starts to burst, and they say, no, it's contained. Don't worry, it's just a couple companies. And then the whole thing implodes, and then they say they were wrong. Well, before the 2008 crash, it was no different. Ben Bernanke, who was then the chairman of the Federal Reserve Bank, kept saying, there's no real estate bubble. There's no economic slowdown in sight. The markets are strong. The consumers are strong. The economy is strong. People have equity in their homes. There's nothing you need to be worried about. And then slowly you start to realize that the real estate market is slowing. And that's when they say, okay, we have a little bit of a real estate bubble, but it's contained. It's only in the real estate market. It's not going to affect anything else. It's not going to affect any other asset class, and it's not going to affect the broader economy. Well, then the real estate market starts to fall harder, and then we start to realize how much it was tied in to Wall Street. And then we start to see the financial markets go down. We start to see the stock market go down, and then they say it's contained. It's not going to affect the whole financial system. And then the whole financial system was on the verge of collapse because we realized that the banking system was trying to double dip, triple dip, quadruple dip off of mortgages. Banks would make a mortgage, chop it up, sell it off in multiple pieces, sell it off in different investment securities, and then insurance companies got involved. It was just a huge financial mess. And then it became way too big, and that one domino triggered the next domino, triggered the next domino, which triggered 100 different dominoes. And so we went from hearing there's no real estate bubble to there's a little bit of a real estate bubble to, okay, there's a real estate bubble, but it's contained to, all right, guys, brace yourselves. The entire economy is on the verge of collapse.
And that all starts with the Fed.
That all starts with the whole bubble was built through the Federal Reserve Bank's actions. The Federal Reserve Bank was the one that was controlling interest rates. The government was also working to create 0% down payment programs to help everybody become a homeowner, because the whole pitch during that time was the American dream is home ownership. If you can own a home, you can become wealthy. So everybody needs to be a homeowner. Banks then came out and said, your home is a great investment because home prices never go down. So all these things were banks, institutions then trying to capitalize on the interest rates and the bubble economy that was allowed by the Federal Reserve Bank. And, so there's a lot of different factors at play. And then in 2020, this is where now it gets funny, because everybody's probably going to remember this now, because this is right in front of our eyes. Well, in 2020, we start printing money. Now, if you watched my channel in 2020, I was talking about how the quantitative easing, the stimulus, the PPP, all these things are going to create inflation. We explained, I started the diagram. What is inflation? What causes inflation? Credit versus money, how this can cause inflation. And during that time, the government and the Fed kept saying, how can you say that this is creating inflation? Our worry is not inflation. Our worry is deflation. We're worried about the dollar gaining too much value. And just so you know, in a deflationary time, your savings go up in buying power, go up in value. Your earnings go up in value. So the prices of things were rapidly dropping, and you had cash to buy things. So people's buying power went up significantly. And that's when the Fed said, no, we don't want that. We want more inflation. Deflation can be very bad for debt holders. So that's what they said. Then came 2021, and we started to see a little bit of inflation. And that's when the Fed said, there's no inflation. This is just transitory. It's temporary. That was the key. That was the word for 2021, transitory inflation. And that went on until like August of 2021, because in August of 2021, the inflation report came in, and it came a little bit lower than July's. So the Fed said, I told you so. I think it was August. It might have been July. But they came out in the middle part of 2021, and they said, I told you so. Inflation is dropping. The inflation problem is over. We told you there's no real inflation. Well, then the next month came, and it was a higher CPI, higher inflation number. And then the Fed's, okay, it's just transitory. Don't worry, it's going to get better. Then came November, December of 2021, and that's when they said, all right, inflation is not transitory. However, it's not going to be that bad. Like, we're already at the peak. It was like 5.5%. And they said, don't worry, it's not going to get any worse. This is as bad as it's going to get. And then came 2022. Inflation got even worse. And the Fed said, we're going to start the fight on inflation soon. And everybody, what we talked about on YouTube was, if inflation is bad, if it's not transitory, why are we going to fight it soon? Why not now? Why are we creating more inflation now? So then came, I think it was March of 2022, and we finally begun slowly the fight on inflation, March or April. And that's when we first started raising interest rates. That's when we first started talking about doing quantitative tightening as opposed to quantitative easing, which means that no longer are we going to be printing money. We're going to start selling off bonds by the Fed. And so that's kind of what happened there. And then after that whole inflationary issue was the discussion on the economic slowdown. Now in 2021, that was when I started talking about be prepared for a secondary recession, because we never really felt the pain of the first recession. And in 2022 was when the Fed and the government first started saying the word recession, and they said, there's no recession. How could you say we're going to see an economic slowdown? The economy is booming. People have jobs. Everything is great. There's nothing wrong with the economy. And then that went on March, April, May. May, people started to get more worried about the recession and economic slowdown. And still, the government, President Biden came out and he had a meeting with Jerome Powell. And he said, we want you to take care of inflation. And Jerome Powell said, don't worry, we got it. And President Biden also said, great, because we're not worried about a recession. The economy is great. The Treasury Secretary came out in May, said the economy is so strong. How can you even think that we're going to enter a recession? Everything is great. July, things started to get worse. June, things started to get worse in the economy. People started to realize the economy is slowing. And then by July, the majority of people started to agree that a recession is coming. And although we haven't officially announced it yet, but a lot of people just see it around them. Consumers can see the prices of things rising. They can see their spending power declining. They can see companies slowing down. They can see companies laying people off, and they're saying, well, it looks like the economy is slowing. And this is where, you can't just trust anything blindly that the Fed says or the government says. You have to be willing to do your own research. And I always say, look, I'm just a random guy on YouTube. Do your own research. My whole goal is to teach you the basics of financial education. That way, now you can go out and make decisions for yourself. I don't want to tell you what to do because my goals are different than yours. My time horizon is different than yours. My risk tolerance is different than yours. What I'm looking for with my investments are different than you. However, the education is the same. And you just got to figure out now what's going on. That way you can make better decisions with your money.
Why is the Fed saying these things if they're always wrong? I mean, are they looking at different data, or how does that process work?
Either the Fed is completely incompetent or they're flat out lying. And I don't know the right answer, which one it is, because, you look at the YouTube comments, I think everybody could have said that this inflation was not just going to magically go away. And everybody's been talking about the economic slowdown for months. Like regular people have been feeling it for a long time. So either they're incompetent, where they're looking at the numbers and they're just not understanding it. I mean, these are smart people, right? They have Ivy League degrees. And I don't want to say this like in a way that's like, oh, I'm a conspiracy theorist. Like, it's just, just the reality. Or they're just lying. And that is possible. Because if you look at what Ben Bernanke said after he was no longer Fed chairman, he was the one who was the Fed chairman during the 2008 crisis. What he said was after he no longer was associate or part of the Fed chairman, he was not longer at that position. He came out publicly and said that we knew things were going to get worse. However, I was not allowed to say anything because we did not want to create panic. We don't want to create fear. And I was instructed by the presidential administration not to go out and discuss these types of things. So, there is the political side to it, unfortunately. The Fed is supposed to be an independent entity. However, they don't always act independent. Like, I think it was June of 2022, the Fed had a meeting in front of the Senate and the House. And the Congress asked Jerome Powell, what do you think about the government's policies of spending currently? And what he said was, I'm not going to comment. And this is where it gets a little bit dicey, because if you are the entity in charge of the monetary policy, the Fed, and you are supposed to be an independent entity, that means you can take criticism and criticize other entities that are making your monetary policies worse. So the government still to this day is enacting inflationary policies. If the government spends more money that they bring in from tax dollars, that creates more inflation. Well, that's what's happening right now. The government is still spending more money than what they're bringing in. And this is where the Fed refused to comment on it. Now, if you're an independent organization, why are you refusing to comment on what the government is doing? Because you should say, hey, government, you're spending too much money. You're causing more inflation. You're making our inflation fight worse. Because the government, President Biden, has told Jerome Powell, the Fed, to take care of the inflation problem. That is the Fed's duty, and it's something that the Fed should take care of. Well, if the Fed is fighting inflation, or trying to, and the government's creating more inflation, and they're two separate entities, you should say, hey, you're making my problem worse. Stop doing that. But he refused to say anything. And so this is where, they are an independent entity, but how independent are they really? Mm-hmm. And, going back to what your question was, this is where you want to understand how the things are structured. But the reality is, the system is just, sometimes, unfortunately, not always honest. And although it is the way it is the best system in the world. But,
right.
It's worse in other countries. But this is where you want to understand what's going on, but then be able to take advantage of opportunities because now you understand it, and then you have the ability to go out and take advantage of it by buying the assets that go on sale.
So how does this all end? Do we need to have zero inflation for our economy to kind of get back on track?
For us to go to zero inflation would require us to get off of this fiat currency system that we're in. So that's very difficult for us to do, because that would require us to go back to something like a gold standard and then not print money besides. I mean, you have to go back to literally a traditional old gold standard, because then there's the money amount is not changing. But what needs to happen in order for the problem, which is the inflation issue, to really get better, is we're going to have to fight the inflation issue, which means we're going to have to pull money out of the economy, which means we're going to have to raise interest rates. The Fed is going to have to do quantitative tightening. And ideally, the government's going to have to start slowing down their spending. And that's painful, because that means they will have to probably cut some of the things that they want to do. They'll have to cut some benefits as well, which is not fun when you're one of the people that want one of those benefits. But it's a necessary thing you must do if you want to fight the inflation problem. And that is going to induce an economic slowdown. That is going to induce asset prices falling. But then that can then allow the economy to refresh, because all the toxic assets, the toxic companies, they will fail, they will go under, or they will be bought out. And that will then allow the economy to start growing sustainably again. And this is hard because it requires things that are painful. Because when companies go under, it's not just the owner who gets hurt, it's also the workers. People lose their jobs. And this is why the Fed doesn't want to see, supposedly they don't want to see an economic slowdown, because they don't want to see people lose their jobs. So we just keep inflating it. But there's a price to that as well, and we're facing that price. And this is where you have to understand that we cannot desensitize ourselves from all risk. There is that pain that we have to go through to be able to manage and sustain a long-term growing economy. And that's the unfortunate reality of just the way the system works. I mean, it's a byproduct of innovation as well. We talk about how great innovation is. Well, it comes at a price. Like, if there was no innovation, then we wouldn't have some of the great products that we have right now. Just go to something as basic as a car wash. We have automatic car washes now. Well, that means that people had to lose their jobs. People who washed your cars lost jobs in order for automated car washes to become a big thing. Look at Uber and Lyft. Hey, it's so much more convenient when you go into a city and you don't need a taxi, but it required taxi people to lose their jobs. So you have to go through pain to get to that thing, to have that better item. And this is where people try to desensitize the risk. We want to have the best of both worlds. We don't want to go through the pain, but we want all the good as well. And you can't always have both. And sometimes that pain is a necessary evil to have the good. And in the economy, we're going to have to go through the economic pain to have a functioning, sustainable, long-term economy.
Listen, I'm just glad you're here to break it all down for us.
I appreciate it. If you want to see more of Nate, check out Nate at his channel, Nate Gregory. I appreciate you watching. Thanks for watching. And as always, keep hustling. If you enjoyed this video and you want to see what's going on with layoffs and why layoffs are about to get worse, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. If you have a profit, you have dead cash sitting in the bank that isn't doing anything. So in this case, these companies want to grow as big as possible, as fast as possible. You don't want to have a profit, and you want to grow quickly.